And now, ladies and gentlemen, let's shift our focus to the intricate world of fundraising with our next panel discussion. We take you through the dynamic world of fundraising where entrepreneurs and investors engage in a complex dance of opportunity and risk. In this exploration of raising funds investors' perspective, we delve into the intricacies of attracting capital from the viewpoints of those crucial individuals who fuel innovation and growth. From venture capitalists to angel investors, we unravel the considerations, the strategies, and the challenges that shape their decisions in the ever-evolving landscape of investment. And today we will navigate the nuanced realm where visionary ideas meet the financial backing that propels them forward. In this insightful session, we are about to delve into the intricacies of securing financial support from an investor's standpoint, exploring key factors, challenges, and strategies that defines the dynamic landscape of fundraising in today's business environment. Our panelists in the next session, each bringing a wealth of experience and expertise, are poised to share valuable thoughts that promise to illuminate the path for entrepreneurs seeking to navigate the complex world of investment. So let's embark on this journey of knowledge and discovery as we explore the investor's lens of fundraising endeavors. Thank you. So firstly, ladies and gentlemen, please join me in welcoming the moderator for this panel discussion, Mr. Vinay, co-founder e-auditor office. Mr. Ravi Teja Gupta, founder Gupta Ji Invest. Mr. Pakkir Mohideen, founder and managing director, Southern Automation. Mr. Chandrashekar Kupperi, Peaceful Progress Fund. And Mr. Karthik, Iyer, partner, Gurukul Ventures. Now, before we hear the experts in the industry speak, why don't we give them a huge round of applause? Over to you, Vinay.
So, a great session, lots of great sessions, lots of awesome insights. Just one request, everyone, especially the students, population students group, don't be silent. So, what's the session? It's about fundraising. Yes, fundraising and product building are two important parts of a startup. And this session we are gonna ask the panel speakers the inside story on investment, on fundraising. So yes, please be active, please be attentive, and I'm not sure if we'll be able to have a Q&A round, but if we have a Q&A round, I request the students community to come with questions. All right. So thank you, everyone. Thank you for your time. And let's start with one straightforward question. Do you think currently there's overhype about fundraising? Founders, instead of focusing on product building or go-to-market strategy, they're more focusing on how do I get funds. So please.
Both are as. Is it working?
Yeah.
Am I audible? Yes. Both are equally important, right? Like product and fund that needs to build product and go to market. Right. So maybe the founder should have a co-founder who takes care of raising funds, and one founder focuses on all other things.
Okay. Thank you. Chandrashekar, please.
So first of all, thank you for this wonderful opportunity. Why there is a rush? Why shouldn't it be? Look at India. We have 1,100 funds. And if you take the year 2016, there were hardly few startups. Now we have closer to 100,000 startups. That's the DPIIT registration that you have. And the funds that are coming in are growing. So there will be a rush when you see that there is a momentum in terms of both the fund flow as well as the emerging startups. But what is the other reason? I think we should admit that entrepreneurship is now given a big push by the institutions too. Earlier it never used to be. For example, take my world. We used to At that time, our parents used to tell us that, you have to study well so that you can get a good job and blah, blah, blah. But today, look at all these youngsters. They have the courage and, even the fascination to be part of a startup or start a startup. How wonderful that is. No wonder why we are called the third largest, in terms of the number of startups. And look at the innovation that is coming. How proud we are, in terms of the new ideas, the new sort of emerging technologies that the startup are even able to build. The corporate honchos, we always used to say that elephants can't dance because there's a lot of bureaucracy in the whole world of corporate. But look at the startups, how disruptive they are. So that is the main reason, that the number of funds that is emerging, the support from the government, the Startup Stand Up India scheme, plus the number of startups that is emerging. That is the reason.
Thank you.
Hi.
So, okay, to Mr. Pakkir.
Hi.
So, just adding to that, adding to what Sir said, and add to my previous question. And also, if you can clarify about between bootstrapping and fundraising, what should ideally a founder prefer? Should we directly try to get funds, or should we strive to bootstrap? Or when should we stop bootstrapping? When should we go for funds, or should we not prioritize funds and plan to have a bootstrap business like Zerodha, for example?
Okay. Bootstrapping, it depends on the entrepreneur's financial capability, I would say. Bootstrapping is a wonderful thing, and that is what Mr. Sridhar Vembu has done. He has completely bootstrapped the company, and now he is mostly he is the sole owner of Zoho Technologies. And the advantage of bootstrapping is you don't have any control from investors. So once the company starts to grow, investors, they will come and pitch in, and they want to take control of the company, and they want to make the company as in their vision. So that is the one disadvantage from the investor side. And from the founder side, bootstrapping, if you have capability to fund your own company, so that's a wonderful thing. You can have your own idea, you can build as per your vision and as per your way. And if you don't have the capability to fund your idea, like fund your company, definitely the next step is fundraising through investors, either through angel or through VCs, or the investor could be a friend or relative or whoever it can be, who has confidence in you, they can invest in you. So once you get into the world of investments, so the priorities change. So you have to work for the investor. So ideally the product what you have built is for the market, but the way you market the product, the way you sell the product, the way you align, the vision you have, is the investor's perspectives come in, and it might change. So that you can take it and you can build your product, or you can have a discussion with the investor, and you have to take the product along the way. So bootstrapping has its own advantages, and investments from the investor also has its own advantages.
Right. Thank you. Karthik, so over to you. Just again summarizing the question: bootstrap versus.
Yeah, I got the question. Yeah. So Vinay, before I start answering your question, the first thing, I come from a finance background, so I worked with hedge funds, private equity funds. I manage a fund right now. I manage a proprietary investment fund, so it's our own money, right? I think what I could tell the entrepreneurs is to really understand the VC mindset. It's important to understand that, and what do you exactly mean by a startup, all right? So I think the word startup is sort of very loosely thrown about, which is fine. There's a government definition of startup, there is a, academic definition of startup, there might be a half-bricks definition of startup, right? So I just want to start off by just giving you a difference between a business and a startup, all right? And it's important to understand the difference, because my answer my discussion would be based on this differentiation between a business and a startup. Suppose, and I'm from a finance background, so it will be a lot of numbers basically, so that you get a better understanding of how investors think about startups or businesses, right? So suppose a business or entity is growing at say 120% CAGR, which is the annual growth rate, right? 120% year-on-year growth. And let us assume that entity is growing in 5 years' time, right? So what is a business? Suppose you start with an entity which is 5 crores in revenue, which is growing at 120%, which for 5 years it is 600%, so it is going to grow at 6 times, right? In 5 years' times, this 5 crores will become 30 crores, right? Because it's 120% into 5 years, 600%, which is 6 times. So 5 crores has become 30 crores, right? So this is 120% growth rate on a yearly basis, a simple growth rate, 120%. So this is typically a business, okay? It's not a startup, right? I draw heavily from a guy called Paul Graham. Paul Graham is the founder of this thing called Y Combinator. He has given a detailed blog post on what exactly a startup is, right? So you go and read it up. It's a great article. So this entity which has gone from 5 crores to 30 crores is actually a business, according to us. It's not a startup. Now you should ask me, sir, what is a startup then? A startup is something which does month-on-month growth. So this 120% growth can also be a 10% month-on-month compounded growth over a period of 5 years, all right? So now can you estimate what will be this 5 crore entity which has grown on 10% month-on-month after 5 years? Can somebody guess how much would be the size of that entity? If you do a compounded growth rate, it is going to become a 1,525 crores company. Are you getting it? So there is a difference between growing 120% year on year, and there is a difference between 10% month on month, all right? Because the compounding happens, right? The same 5 crore company has become 30 crores in one instance. The same 5 crore company has become 1,500 crore company in the other instant. Are you getting my point? Did you guys understand it? I hope I have not confused you guys, right? The problem is this: a lot of people are doing businesses and they are trying to pitch it to VC investors who are interested in investing into startups, right? Are you getting it? Now the challenge is this: you can convince yourself that my business is a startup. That's what happens. For example, what is the difference between I can give you an example. A restaurant business is a business. Zomato is a startup business. Are you getting it? Because Zomato can grow rapidly, a restaurant cannot grow rapidly. Because restaurant you need to have a place, you need to invest into the local marketing and so on, right? Now you can pretend my restaurant business is a startup business by saying that I'm going to set up 100 restaurants, 1,000 restaurants, right? It doesn't make it a startup business. And the problem is you go and raise money from VC investors. Now what is a VC? VC guy is taking money from some guy sitting in the US and he's saying that I'm going to invest into Indian startups. So the VC also has a compulsion to invest that money. That's how his investors are going to evaluate him, right? He has raised some $300 million, now he has to put this money to work, right? So he has to invest the money. So firstly, you convince yourself that my restaurant business is a startup business, whereas it was a business, right? Now the VC has to invest, so he also convinces himself that it's a startup business, all right? And he puts that money. Now the problem is that business is a business. Just because you start believing that it's a startup, it doesn't become a startup. And that's where the entire conflict comes in. VCs start investing money, startups start raising money. In the media, it is like I have become $1 billion business. No, it's all on paper, all right, in terms of doing that, right? So first thing that I would suggest to you is that figure out whether you're a business or whether you're a startup. If you're not growing at that level, my advice is don't raise VC money. Because VC money, all that numbers are all nonsense. Let me tell you that, right? Nobody makes that money, right? You make money only when you go and IPO or you are basically, there's an exit event which is supposed to happen. Somebody acquires your company, right? That is a very, very low probability event, right? Suppose Walmart comes in and you are able to convince that this is a startup, they will come and buy your company or somebody will give you an exit, right? The probability of that is extremely low, right? The VC guy is going to invest into 10 startups and hope that one of them is going to succeed. You as entrepreneur, this is your lifeblood and this is what you want to do, right? So the VC already assumes that 10 of you, the kind of guys he's going to back, out of that 9 is going to fail. But this is your entire, all your eggs are in your basket, in your business basket, right? So the are two things that you need to understand is that if you are a business, right, try to grow it as a business, which is like a profitable business, try to scale it up and all that, right? If you are a startup, then you cannot be profitable. That kind of growth requires a lot of capital to be able to grow. Zomato cannot become couldn't be started as a profitable business, right? It requires VC money, right? So I think the key thing, whether to bootstrap or not to bootstrap, depends on your understanding of the business, on whether it's a business, or there's nothing wrong in both of them. It's not that a startup guy the business guy ends up making a lot of money. If you look at traditionally, startup is a very high risk, high return kind of environment, right? I mean, asset class, right? So if you look at traditionally in India, you just look at the data, the guys who do businesses end up making a lot of money and creating a lot of wealth, creating a lot of employment and so on, right? Whereas, so that's my thing to you is that you need to do a reflection to understand that whether it's a business, whether it's a startup, for yourself, right? And then figure out whether external capital is required or not capital. If it's a business, try to manage it through your own money. Or if it's a restaurant, for example, try to take some franchisee partners where you're getting somebody to invest that money and so on, right? Because it can become profitable and it's great. If you're making 10 crores, 20 crores of profit every year, that's much better than having a company of like $1 billion, but you don't have any money basically. It's all kind of a paper valuation, right? So I don't know whether that answers your question. So first thing is, you have to be truthful to yourself whether you are building a business or a startup. And if you are building a startup, and if you know that you require the capital, then you need to start pitching to investors, right? Yeah.
Thank you, Karthik. I think you mentioned the hard truth. So we need to understand if what we're building, if that's like the business, or if it's a startup. So summarizing this, what I usually tell to my clients, what we usually believe is, if you have reached a stage in your business where if you get funds, you can grow exponentially, okay, maybe like 10x, 5x, within a quarter or within 6 months, then go for funds, you need funds. But if you think, if someone invests $1 million in your business, you hardly would be able to grow maybe 50% a year, or 100%, 120% an year, and most of the fund is just going to lie down and not give you any growth, then maybe you should see if you can bootstrap or decide if you should go for debt capital or strategize. So that's how it needs to be done. I have very often seen, just like Karthik mentioned, funds lying in the bank accounts of startups, and they absolutely have no idea how to use it, and then there's no growth coming out of it, and then they fail to raise the subsequent round, and then they eventually they'll have to shut their business because the founders, they had in the vision that 10 crores first year, 100 crores in the second year, 500 crores, 600 crores in the third year, but in fact the revenue projections, actual revenues would be something like 10 crores, 15 crores, 20 crores, and then they lose hope and they just shift their business. So thank you guys. Okay, so let's talk about the elephant in the room. What are the key factors you consider when deciding to invest in an early stage startup? And all the school students, please pay attention, a very important question. So starting with you, Ravi.
Any investor investing is only for one reason, to multiply their money.
Right.
So there are other asset class like land, gold, mutual fund, fixed deposit and all, where it is low risk, low returns, or medium risk, medium returns. Sometimes medium risk, zero returns and all. So maybe I think like 10% or 20% of the investors' money, they want to keep it on high risk, high returns, which is investing in startups.
Okay.
So the startup has to be fundable.
So what makes a startup fundable? When can you say that this particular startup is fundable? It needs to have A, B and C. Or
business ka business, profit is the priority, right? Here it's the valuation is a priority. So to get the maximum valuation, like is it a completely new market, like monopoly or duopoly is practically possible to make, like food delivery only Swiggy, Zomato, you don't have third other option, right? Like that.
Right.
So more monopoly possibility, more valuation of the company, for which the market size also has to be there, and it should be a painkiller, not a supplement.
Got it.
Example, if you are hungry, Zomato, Swiggy is a painkiller, right? It's not a supplement. So there are many other, so it has to be a painkiller startup where people will be interested in paying. So example, the groceries in 10 minutes, people think it is a painkiller, but I don't think.
Okay. Well, I think that's time will say, quick commerce, how it's going to pan out. But over to Chandrashekar sir, I would like to add, he correctly mentioned about valuation. So please also guide about valuation. There's too much hype about valuation also.
So let me first say that choosing a startup is both an art and science, but largely an art. At an early stage, it becomes more of an art because the business is still trying to find out how they can grow. Probably they are still finding out the product market fit. But because we are speaking about startup, there is a definition for startup, and I'm going to use something and then relate why I'm even using this. A startup is actually defined as a company that is designed to grow quickly. That's it, compounding. So that's the beauty about a startup. It has to grow at a compounded rate of growth. That's what we are looking at. In fact, Steve Blank defined even better. He said, startup is a temporary organization designed to search for repeatable and scalable business model. So can you ensure that there is a repeat customers and therefore the business can scale? That's a definition of startup. But I'm going to borrow something very different from Nelson Mandela. He said, there is no passion to be found playing small in settling for a life that is less than the one that we are capable of living. That is the true definition of startup. Can you have the magic of thinking big? Bada sochna chahiye. That is the meaning of startup. Now you ask the question, what are the criteria that I use, as a fund? My answer is going to be very, very odd because I picked this from a movie called Scream. How many of you have heard of this movie called Scream? I think there is a version 6 also which has come. But why I picked up is there's a parody also, the comedy version of Scream. And what does the Scream stand for as a criteria? So S stands for scalability, because if the business is not scalable, none of the funds are going to look at it. What is scalability? It's about understanding how big the market is. Can I capture that large market? Let's say in the next 3 to 5 years, if you take the SAM, and the SOM, how much of that SOM I'm able to garner in the next 3 to 5 years? That is the market, the magic of thinking big. In that Scream, the C is the most important because that stands for capable team. So when we speak about capable team as an evaluation criteria, what we are looking at is not just the domain knowledge. There are 2 important aspects that we look at. One is what is the cohesiveness within the team? How well they gel? What sort of mutual respect they have? Because in the previous panels we heard, if there is a rift between the co-founders, what do we do? So I think one important aspect that we always look in terms of capable team is their mutual respect for each other, and of course the domain knowledge, their sense of urgency, all that matters a lot. In that Scream, the R is very important because that stands for resilience. What I mean by resilience, it's a very commonly or loosely used word, but for us, when we evaluate, we want the startup founders even to tell us, how they look at the highs and lows of their journey. Because none of our life, has always been on the upward curve. All of us, have seen the downs too. So we just want them to help us understand how they have maneuvered, how they have pivoted in that journey. But more importantly, when I speak about resilience, I want them to explain how they treat the competition. Are they respecting the competition? Because competition is lurking all around, both direct as well as indirect. So for me, resilience is all about the journey, the highs and lows, as well as how well they understand the competition. Now comes a very, very important word. It's called energy, because startup is all about energy. We use this word enthusiasm. To me, enthusiasm ignites greatness. That's your X factor. The way you come across, the way you explain, the josh that you show in terms of your action, not just the communication, makes a huge difference. And of course, the A is again critical because it's called anticipating success, which means are you right structured even to receive the investment? For example, do you guys know what sort of amount that you need? Why do you need the amount? What is the utilization? Forget about the valuation, we'll come to that, but at least the usage, how long this money will last, what sort of new metrics it is going to give me as growth. That is called anticipating success. And finally, M is closer to my heart. I'm a Pakka chart accountant, metrics. I always say that if you can't measure, you can't manage. And if you don't manage, we damage. So I think this metrics is very, very important in terms of understanding what is traction, what is momentum, how do you look at some of the way by which you are managing and progressing on your business side. That's the Scream. You asked me about the valuation. Again, valuation is largely an art, then a science at an early stage. Nobody knows. In fact, it's only an educated guess. That's what I would say. But look at this. The startup valuation exercise is always a friction point between the founder, because the founder is right-brained storyteller. The story is what the founder is always behind. How well he is able to articulate what is happening with the business. So it's a right-brained storyteller. But look at the other side, the investor, left-brained number crunching guy. Always, in terms of how do you look at When is the growth? Therefore, profitability. And then the various versions of profitability. You know, what's your gross margin? What's your net margin? What's your EBITDA? Blah, blah, blah. What I'm saying is that there is that friction that always happens. But then I think investors are also cute. They understand that when it comes to the startups, their ability to think out of the box, you know, that creativity is something that we hugely respect. So let's give a big round of applause to all the startups, because it is absolutely amazing to even run a business. As you rightly said, VCs even don't know, you know, what is that business all about. Of course, we have taken the money, probably we're putting in our money, but end of the day, huge respect for the startups, because the way you run the business is absolutely a miracle. So what we are trying to convey here is that we definitely celebrate the creativity that you have, but somewhere, when it comes to the valuation, we want you to balance the creativity with the fundamentals of the current operation. Where you stand is very important when it comes to valuation, because you can literally turn down the interest of an investor if you come with a ridiculous valuation. Therefore, my request is, if you're not sure about the valuation, come with a discovered valuation. That's why you've got something called convertible. Come with a convertible option by either giving a discount, or come with a convertible option of saying a floor and a cap. You can be creative even in terms of structuring how you should raise the money. I'll stop there.
Thank you. Over to you, Mr. Pakkir.
My perspective is, as an investor, investor knows this hard truth. Out of 10 investments, 8 is going to fail. Investors, as investors' perspective. So the investors look for whether this startup, whether the startup I'm going to invest is going to survive in the first 2 or not, whether it will succeed or not. So for that, he will look for certain characters. Like the first one is attitude, like what he said is right. The first one is attitude he'll look for. Like this is what the same thing Mr. Elon Musk, he will say. Like he will always look for, like he will always make the mistake of looking for talent than personality. But still he is doing the same. What he says is, so far the years he was looking for the talent than personality, but personality is the main thing to look for the founder's attitude. Like attitude is the main thing, because when you don't have money, your attitude is different. When you have money in your hand, your attitude is different. So the investor will look for the right attitude, not only in the founder, but also in all the persons of a team, like a founder, co-founder, how they are going to handle their money. The ultimate aim of the investor is to multiply the money. Mainly it's because they have to answer their HNIs. The investors are like, I would say, investors might be angel investors, VCs, or the individual investors. They get the funds from the HNIs, the banks, or from some unknown persons. So once they invest the money in the startups, they have to answer to their, maybe they'll call their superiors. So they have to answer their superiors. So before they invest in a new startup, they look for attitude, and the next thing is they look for scalability. So whether these guys are going to solve the global problem or not, whether these guys will going to give a solution for the whole world. So if this startup succeeds in India, whether this can be scalable to some other countries. So in that way, he can make money. So these two things, and the next thing is to get the first conference, to get to the investor table. Once they see the pitch, they look for some tax. Tax in the sense that is, in my perspective, that tax is not necessary, but most of the investors' perspectives, if the founder has come out from IIMs, IITs, or some top universities, it is evident that he can able to run the show. So that is what the investors' understanding in the market. So far, I have met a lot of investors. So that is their understanding. If he has some tax behind him, they are confident that he can able to run the show with his money. So that is these are the three things he is looking for looking in a founder.
Okay, thank you. Karthik, I'd like to modify my question a little bit for you.
Good.
Let's make it a little more challenging.
All right.
So Ravi mentioned that monopoly is something that investors look for. Definitely, blue ocean is what they prefer. But there are so many startups doing well, and a founder cannot choose which idea comes to his mind. So, say for example, there is a monopoly in a particular market where, say, there are two big startups in a particular market. They have like almost the entire 100% market share is with them, 60-40, and a founder wants to enter that space because he has experience in that space and feels that he has a good idea. So as an investor, what are the certain things this particular startup or founder needs to have, which would A, help him succeed and beat the competition, B, make you invest in that startup?
Sure. So it's a very interesting question. So what he's saying is that there's already a market, there are already two dominant players, and as a founder, I have an exciting idea in that particular space. How do I approach that particular market? Is that right?
Absolutely.
So, see, the days of monopolies are gone.
And also, from the investor's perspective.
Yeah. So firstly, it depends on the sector, for example, right? How much is the barrier to entry in that particular sector? So for example, if you are in the oil and gas sector, right? And Reliance is the monopoly there, obviously you cannot enter that sector, all right? So if you are a startup, the way I defined it, right? Monopoly doesn't matter because the fundamental trend itself changes today. So today say Zomato is there, Swiggy is there. Those are the sort of the dominant players in the food ordering market, right? But can I create an AI system which can actually recommend me what I should have today, for example, right? And can I capture that particular market? Are you getting my point? Depending on what I have ordered, how I have ordered and stuff like that. That's a great market. And people will come to you. Why? Because you are taking away, when I go to a Zomato app, I don't know what to have, right? I'm spending so much time in making that choice. But if I have sort of an AI co-pilot who is going to tell me, hey, today it seems like this and you should have, I don't know, something, I don't know, roti, chal dawala, whatever that is
note
specifically.
Of this idea.
And
so I investor also.
So I think monopolies don't like innovation. They like the status quo, all right? Because that's why they are monopoly, right? But what will happen today, thanks to AI, right? That is the future. AI will just kind of, uproot all monopolies, right? Every monopoly will come and tell you, oh, we are doing AI. They are not doing AI, all right? They might be just doing AI just to tell to their investors, right? They are not actually using AI to focus on their customers, right? AI would be a fundamental shift in how things are done in our society, all right? So if you have a smart idea, if you can use tools like AI, then you will succeed. Now, I always thought earlier the kind of thought process was if Google was doing something and Microsoft was doing something, you should not start in that particular space. I think if Google is doing something, Microsoft is doing something, you should start something in that place. And I'll tell you why. Those large companies have become like bureaucracies today, honestly speaking, right? They can't move fast enough. They can't focus on, what is the advantage of a startup? Startup is very nimble. You can do what the customer wants, right? And the customer will come to you. Earlier, there was a barrier to entry, you can't market. Today, it's a digital world at the end of the day, right? If you are a cool app, if the customers love you, they're going to recommend you to their friends, right? So it's a very easy market today to become and compete with a monopoly because if you can focus on your customers, you are nimble, you are actually solving a problem that the customer has. It's very easy to grow extremely fast in today's environment. And if you are in the area where Google, Microsoft or one of these larger companies are, they'll come and buy you out, isn't it? WhatsApp was what, like 100 people company or something, they got bought out for $18 billion or something like that. Are you getting my point? And that was a great buy for Facebook. Today nobody uses Facebook, there are a lot of people who use WhatsApp, right? So what I'm trying to say is that if there is a monopoly, you have a very exciting idea, and if you can scale it up very fast, we would be very excited to look at you. I mean, I think that's an advantage rather than a disadvantage that way,
Awesome, great.
I want to add some points here. This monopolistic or duopoly, if there are two companies, I'll tell you the examples. Example, Ola, Uber, only two were there. But BlueSmart came with only EVs. So there is chance that people may prefer BlueSmart than going for Ola, Uber, right? So if you are entering, what are the new USPs that you can create? So government made it mandatory that by 2030 all the aggregators should have only EVs. So GlueSmart is already doing it, right? So example, Rapido started cabs. So they instead of charging commission from the drivers, they are charging like, I think, subscription model. So they are telling that we are not an aggregator because we are not charging commission. So they don't need to come under that only EV model. So and Rapido started with two-wheelers when Ola Uber did not have two-wheelers. So they were ride-hailing platforms. It is easy for them to start another vertical, but to create that market, it takes time.
Right.
So when there is already market, still even if it is duopoly, also we can search for what are the new,
we can still be innovative
new ways.
and
Yeah, still
find
innovation.
gaps.
Innovation is like, it's an unlimited thing. Like.
Awesome, thank you. So we are nearing the end of this panel discussion. Unfortunately, we have not much time here, but so we have a lot of youngsters here. Let's keep the answer very simple. I just want one line answer from each one of you, because that would highlight the priority. What is the one single most important thing a startup should have to make it fundable? The one most important thing.
Value addition, value creation.
Awesome. Value addition, value creation. So the startup must be adding some additional value than the competitors, must be creating some additional value for the users. Super.
Vinay, with your permission, 2 lines. Okay? 2 lines I say. So I think the most important aspect that the startup need to work on is what problem are you solving? A problem well defined is a problem half solved. Because if that problem is something that you truly know, you will appreciate that the market size is also bigger. So what we say is that whenever we look at a startup is that problem popular? Is that problem urgent? Is that problem growing? Is that problem expensive? Is that problem mandatory? This is what we are looking at, the frequency also. So I think focus on the problem, and if you truly understand the problem, spend significant time. Don't come up with a solution right away. Because only when you know the problem well, you will understand that the market size is also big, and to the startup definition, unless the market size is big, none of the investors are going to get excited also. So focus on that.
My view is like I said, the right attitude will always attract investors. In the current scenario, I would say personally, getting investment is easy because a lot of investors are there in the market. So if you have to reach the right investors. For that, networking is the first priority. Like you have to network with all. For that, LinkedIn is a best tool. So use LinkedIn to get the networks, and once you get the network, you will get the investors. So investors will look for the right attitude. So if you have the right attitude, then you will definitely will get the investments.
Super, thank you.
The challenge in being the last speaker is a lot of it is already covered. So let me figure out something. I think one of the things that I would kind of recommend entrepreneurs is do it for the right reason. I mean, in the sense that why are you doing something, right? If you do it for some external reason, some ego boost or something like that, right? I think startup journey is extremely difficult is what I have seen. I've been an entrepreneur myself. I'm a first generation entrepreneur. It is extremely difficult. It is a lot of uncertainty and things like that, right? So if you're not doing it for the right reason, then you'll give up very fast is what I've seen, So do something that deeply resonates with what you want in life, your value system or something of that sort, right? There's a lot of noise in the market and this is a solution and you can become a billionaire by creating it, right? Figure out, is it that you really want to do? Because it's a very lonely journey as well. You might have co-founders, you might have investors, you might, even your personal, your wife, husband and all that, right? But at the end of the day, it becomes an extremely lonely journey. So one thing that I would say is, even before you embark on the journey, give it a lot of thought, should I really embark on this journey, and do it for the right reasons. It's a fantastic journey, I wish you all the best, but it is also a very difficult journey. So there are pros and cons to everything, I guess.
Awesome, thank you so much. So summarizing this, I think the summary is, we need to ensure that we're adding some value, creating some value. Creating some real value, not creating value in your mind. So creating some value for the customer and with the right attitude. So unfortunately guys, we'll have to wind up here and we don't have enough time for a Q&A round. But the speakers will be available offline. Please don't let them leave. Don't let them have lunch. Okay. Please utilize this, utilize their mind, utilize the experience. And thank you guys. Thank you for your time. Thank you for all the insights. Thank you. Thank you.
Thank you.